If I had to start investing from zero in 2027 with no financial experience and only a small amount of money, I wouldn't try to find the next Bitcoin. I wouldn't try to guess which stock will explode. And I definitely wouldn't wait until I had $10,000 sitting in my bank account. I'd follow a simple 5-step plan. And in this video, I'm going to show you exactly how I'd approach investing in 2027, from your first dollar to building a long-term portfolio. But before we start, remember, investing always involves risk, and there are no guaranteed returns. Before investing, I'd make sure my financial foundation was strong. First, I'd build an emergency fund. Why? Because imagine investing your money today and then your car breaks down tomorrow. If you have no emergency savings, you might be forced to sell your investments at the worst possible time. So I'd first work toward having cash available for unexpected expenses. Next, I'd look at high-interest debt. If you're paying extremely high interest on credit cards, investing while that debt keeps growing may not be the smartest first move. The goal isn't just to invest. The goal is to create a financial system you can actually maintain.
If you work for a company that offers a 401k with an employer match, I'd pay very close attention to that match. Because when an employer contributes money based on your contribution, you're potentially getting additional compensation as part of your workplace benefits. Don't leave money on the table without understanding your plan's rules. For 2026, the IRS says employees can generally contribute up to $24,500 to a 401k, subject to the applicable rules and limits. But here's the important part for this video. We're talking about 2027. The IRS adjusts many retirement plan limits over time for cost of living changes, so don't assume the 2026 number will be the 2027 number. Check the latest IRS limits when 2027 begins.
After taking advantage of an available employer match, I'd look at an IRA. You may have heard of two common types, traditional IRA and Roth IRA. With a traditional IRA, contributions may be deductible depending on your circumstances, while withdrawals are generally taxable under the applicable rules. A Roth IRA works differently. Qualified withdrawals can generally be tax-free, but Roth IRA eligibility depends on factors including income and tax filing status. For 2026, the IRS says the total contribution limit across your traditional and Roth IRAs is generally $7,500, or $8,600 if you're 50 or older, subject to the rules. Again, that's the 2026 number, not a guaranteed 2027 limit. So if you're watching this in 2027, check the current IRS limits before contributing. Now we get to the question everyone wants answered. What should I actually buy? For a beginner, I wouldn't try to build a portfolio around 10 random stocks. I'd focus on diversification. Instead of putting everything into one company, you can consider diversified funds that hold many different investments. For example, broad market index funds and ETFs are commonly used by investors to get exposure to many companies at once. The advantage is simple. If one company has a terrible year, your entire portfolio doesn't necessarily depend on that one company. But remember, diversification does not eliminate investment risk. Your investments can still fall when the overall market falls. The SEC's investor.gov explains diversification as spreading money among different investments to help manage risk. And I'd also pay attention to fees. A fee that looks tiny might seem unimportant, but over many years, investment costs can reduce the amount of money that stays invested and compounds. This might be the most important step. I wouldn't depend on motivation. I'd automate my investing. Imagine getting paid on Friday and automatically having $50, $100, or another affordable amount transferred into your investment account. You don't have to think about it every week. You don't have to ask yourself, should I invest this month? It simply happens according to your plan. This is similar to dollar cost averaging, investing equal amounts at regular intervals, regardless of market ups and downs. When prices are lower, your fixed contribution buys more shares. When prices are higher, it buys fewer. The goal isn't to predict the perfect day to invest. The goal is consistency. And what if you don't have hundreds of dollars to invest? Start with what you can reasonably afford. Let's say you invested just $5 a day.
That's approximately $150 a month, or about $1,825 over 1 year. Now, imagine doing that consistently for many years. The money you contribute is only one part of the story. The other part is time. Compound growth means your investment returns can potentially generate additional returns over time. That's why starting early can be so powerful. But remember, these are not guaranteed returns. Markets can go down and you can lose money.
If I were starting in 2027, I'd also avoid 5 major mistakes. Number 1, trying to get rich overnight. Number 2, investing money I need for short-term expenses. Number 3, putting everything into one stock. Number 4, constantly buying and selling because of market news. And number 5, ignoring fees. The market will always have another headline, another crash, another next big stock. You don't need to react to everything. You need a strategy you can stick with. So if I had to start investing in 2027 from zero, I'd keep it simple. Build an emergency fund. Handle expensive debt. Take advantage of an employer match when available. Understand your IRA options. Choose diversified investments that fit my goals and risk tolerance. Automate contributions. And most importantly, give the strategy time. You don't need to become rich tomorrow. You need to build habits that can make your financial future stronger over the next 10, 20, or 30 years. And that's how I'd start investing in 2027. This video is for educational purposes only and isn't personalized financial advice. The investing concepts above are consistent with investor.gov guidance on regular investing, compound growth, diversification, dollar cost averaging, and investment fees.